Is the AI market in a bubble?
We see signs of an AI bubble.
There could be an AI bubble.
Is the AI market in a bubble? That's what OpenAI CEO said.
Take a look at this chart. It shows us the contribution of AI spending relative to GDP. It's just done something quite incredible. It has now exceeded this other line, which corresponds to the contribution of consumer spending as a percentage of GDP. What this chart is telling us is that spending on AI by large technology companies is now officially a larger contribution to GDP than consumer spending in 2025. So the excitement around AI is actually beginning to take over not only the stock market, but the economy as a whole. Many people, both in the tech industry and in the financial industry, are beginning to argue that an AI bubble has formed or is forming. Asset bubbles tend to end with pain, both for the stock market and the economy. If we're really experiencing an AI bubble, it's now more important than ever to understand exactly at what stage of the bubble we currently stand. These are the earnings forecasts for US technology companies by Wall Street analysts. They've been going through the roof and almost going parabolic in recent months. This institutional excitement around the technology sector has provided the fuel for certain stocks exposed to the AI theme to reach quite incredible valuations. Nvidia currently has a price to earnings ratio of 56, Tesla of 190, and Palantir of 519. Now, to most people, these are numbers that don't really mean much, but what this essentially means is that Palantir shareholders would need to wait 519 years to make their money back if the company stopped growing today. For comparison, the S&P 500 index currently has a PE ratio of 29. The US small cap index is roughly at a PE ratio of 17. So in other words, investors are paying 30 times more money for a share of Palantir relative to a share of a standard US stock. That's not exactly the type of thing that Warren Buffett would be very excited about seeing. And to many, this is reminiscent of the behavior of technology stocks during the bubble of the late 1990s. These were all companies that were growing quite rapidly. The problem is that with these high valuations, investors were extrapolating that this growth would continue at the same rate far into the future. Whereas when these companies ended up disappointing these crazy growth expectations, the technology sector made a 180-degree turn as investors needed to quickly readjust their growth expectations to catch down to the reality of the situation. This is what triggered one of the worst bear markets of the last 70 years, wiping out 50% of the total value of the US stock market and triggering a pretty painful economic downturn as a result. So just how close are we to this kind of painful scenario today? Typically, there are three phases to any bull market. The initial phase, where early investors are jumping in, the awareness phase, where institutional capital is picking up on this theme and investing in it, followed by the mania phase, where you have extreme enthusiasm, significant media attention, which drives returns through the roof, putting in a large peak. This is the phase that we can categorize as the bubble. And then we have the pain that comes on the other side of it. Today, as we can see from widespread enthusiasm on AI and the significant media attention that it's garnering and the high valuations, we know that we're somewhere in this mania phase. This, by the way, is typically the moment where the returns being made by the asset in question are the largest and where the most amount of money is flowing into the space. So exactly where are we in this phase? In order to answer that question, we need to look at the three things that drive price during this mania phase. And these are going to be able to tell us with a pretty high degree of certainty exactly how much longer this can go. The first is the momentum of the narrative. AI is not just a long-term speculation of what the world is going to look like in 10 years. There's real adoption that is taking place as we speak. Businesses are incorporating AI into their processes, streamlining their costs, and increasing their productivity. Currently, the AI adoption rate stands at 9.2%. This is using data from the Census Bureau that measures how quickly firms are adopting artificial intelligence across the economy. And what's quite incredible about this is that the rate of adoption seems to be accelerating. This is a big part of what is driving the current behavior of the technology sector. There is an acceleration of AI adoption that is happening right now. As we saw earlier, the expensive prices of AI stocks today currently suggest that investors are projecting that this growth is going to continue at least the same rate in the coming months or even years. Now, as long as adoption actually matches these expectations, the bubble is likely to continue. If all of a sudden AI adoption shows signs of slowing down, investors are going to quickly readjust their projections, which could lead to a significant repricing of these stocks. Although there is clearly extrapolation that is happening, we're not yet seeing signs that this trend is actually slowing down. The second key factor is the abundance of liquidity. Liquidity is how much money there is available in the financial system that can flow into various assets. As long as there's an abundance of liquidity, odds are that money will continue to flow into the most hyped narratives that are currently in the market. How much liquidity there is in the financial system is primarily dictated by what central banks are doing around the world. If global central banks are raising their interest rates, that makes borrowing more expensive and that reduces liquidity. When global central banks are cutting rates, that increases liquidity. So far, just the first half of 2025 has seen over 60 rate cuts from global central banks. If we compare that to other years, we see that this is the second largest number of rate cuts by global central banks in the first 6 months of the year. The only year that exceeded this was 2020 in the middle of the pandemic. And today, major central banks like the Federal Reserve have been announcing more rate cuts to come in the coming months. So liquidity right now is abundant and doesn't seem to be showing signs of tightening just yet. The final key factor is the momentum of price, and this is by far the most important one. This is the chart of the Nasdaq 100, the US technology index, in the late 1990s and early 2000s. You can spot the various phases of the bull market that we discussed earlier. If we zoom in a little bit closer on the mania phase, and we add some moving averages to show us what momentum looked like, we see that the momentum of the bull market was extremely strong during this entire final phase of the bubble. The moving averages were all pointing upwards and price was consistently above all key moving averages, only very briefly dipping below them. When the peak was made, however, we can see that momentum began to turn around. The moving averages curled downwards and price struggled to stay above them. As soon as this happened, it marked the beginning of the dot-com bubble. The reason this is so important is because asset bubbles are all about the momentum of returns. During bubbles, most investors know that what is happening is irrational, but they still participate in this irrationality because returns are higher in this part of the market than anywhere else. As long as the momentum of returns stays strong, investors will continue having a reason to pile into this trade. But when momentum slows down, that's precisely the moment where that part of the market becomes vulnerable to swinging in the very opposite direction. Today, when we look at the US technology sector, its momentum is strong. The moving averages are all pointing upwards and price is holding up nicely above them. It dipped below them very briefly at the beginning of this year, but the underlying adoption of AI has helped push these stocks right back into a strong posture. Now, as of the making of this video, we actually have a very short-term bet against the Nasdaq 100 at Bravos Research, because we think the odds of a small pullback in the short term are quite high. But we also think that in the current bubble environment, pullbacks in the technology sector are to be taken advantage of. As George Soros once said, "When I see a bubble forming, I rush in to buy, adding fuel to the fire." AI stocks are a bubble that is forming, and we're looking to add fuel to the fire. We've studied the greatest macro traders of all times at Bravos Research, and we've adopted the very same principles that they use to build incredible wealth in the market. These rules are what allow us to be exposed to the right parts of the market at the right moment, and also make sure that we have very limited losses when we are wrong about the future. This has provided an average gain of 20% on our winning trades versus a 5.5% loss on our average losing trade. We reveal each and every one of the trades that we take to our clients at bravosresearch.com. If you want to become one, click on the link down below and subscribe. You won't regret it. Thank you for watching.